It is a real honor for me to chair this panel of high-level experts on fiscal policy, a medium-term view. Working at the European Stability Mechanism, the European dimension of that question is very clear. Germany is our biggest shareholder, and the credibility of the stability mechanism to a large extent also hinges on the creditworthiness of Germany and therefore its public finances and its medium-term fiscal policy. The point is very clearly, I think, that German fiscal policy has a domestic dimension and it has a European dimension, both politically and economically, and that will be part of today's discussion. And I would really like to commend the Bundesbank and the International Monetary Fund for putting this topic on the agenda, because it actually attracts a lot of public attention as well, nationally and European-wide. Now, the relationship between the European dimension and the domestic dimension of fiscal policy has been tenuous at times for Germany. One of the first publications I had when I started as a young economist at the Bundesbank was actually entitled "The Tumbling Giant, Germany's Experience with the Maastricht Criteria." And it was telling the story why Germany had actually trouble in respecting the Maastricht criteria. Some of you may also remember the 2003 episode when Germany did not follow up on the recommendations of the Commission to consolidate, and that was by some understood as one of the key elements in actually weakening the European fiscal framework. Nowadays, the situation looks much different, and it is actually the principle to achieve a balanced budget, die schwarze Null, has guided fiscal policies for a couple of years. And therefore, the budget balance looks good, and that is falling. Actually, Germany has overachieved the targets set, the quantitative targets set by the fiscal rules on a European level, but also on a domestic level. And the question arises whether Germany could do more to support growth, long-term growth, and do that more forcefully. Another important and also highly controversial issue is obviously what is the objective of German fiscal policy and whether German fiscal policy should take into account European activity. Now, the organizers of the conference encouraged the chairs of the panel to engage the audience. And since this is a controversial issue, and I think it will set incentives right for the presenters to engage, I would like to have your view on this issue. And therefore, I would like you to raise your hand and reveal your views. So could I please ask those who think that German fiscal policy should take into account the impact on European activity and now show that you think this is the right approach? Could I now ask the reverse question and those should raise the hand that think that Germany should exclusively look at domestic activity and at domestic growth when fiscal policy decisions are taken? So that shows quite a surprising lack either of courage or a rather undecided audience. In any case, I hope it helps you to make your case for whatever is your view and try to impact on the audience. Now, on the panel, the presentation will be done in alphabetic order, and either by chance or by a very careful selection. This means that a presenter who gives a view on German fiscal policy from a more outside perspective will be followed by a presenter who will give a view more from a domestic perspective. We will start with Manfred Bergmann. He is director in the European Commission and is in charge of economies of member states. The second speaker is Lars Feld. He is professor at the Albert-Ludwigs-Universität Freiburg. He is director at the Walter Eucken Institute and member of the German Council of Economic Experts. Then he will be followed by Daniel Gros, long-standing director of the Center of Economic Policy Studies in Brussels and appreciated commentator on European issues. And the final speaker is Ludger Schuknecht. He is chief economist of the German Ministry of Finance. The floor is yours, and Manfred, please give it a start.
Yeah, thanks, Rolf. And I'm positively surprised that so many people are still undecided on whether Germany should take into account international spillovers when it designs its fiscal policy. But thanks a lot for inviting or for organizing this event by the Bundesbank and the IMF, and for inviting someone from the European Commission to get across its messages, which are to a large extent known, I hope. Nevertheless, given one of the hosts, I also like to talk about weather conditions, about house repairs, but I might also want to talk about swimming pools, beer gardens, the best pupil in class, and perhaps beer tents. It's clear the sun is shining over the European economy, not in all spots, but over most spots it's now shining. On some regions it's still clouded, but the sun is shining brightest over the German economy. All the data are very encouraging. The German economy is enjoying solid economic expansion. It's growth above potential, employment at historical height, and unemployment at a record low. The fiscal position is comfortable and keeps strengthening, so everything is fine. This does not fall like manna from heaven. It is also due to fiscal consolidation, to reforms in the past, at the beginning of the 21st century, if I may want to say so, where German policymakers fixed the roof. At that time, I think it wasn't really sunny weather. It was already raining a bit, but they fixed the roof with all the reforms in the early 2000s. Since then, there has been some, according to our understanding, reform inertia, and we have the adverse impact of a rapidly aging population in Germany. And as a result of this, the European Commission expects that potential growth, which is at present at around 2%, will be going down to a little bit more than 1% in the medium term. And I would like to make my point upfront on fiscal space and on the current expansion and the solid fiscal position we are having. This is now the time to invigorate the German business model, to strengthen the growth potential in Germany, and thereby safeguard fiscal sustainability in the long run. Specifically, the main task facing policymakers at this juncture is to use the fiscal space which exists wisely, and push forward long overdue reforms. And that means we have to avoid the challenge of yielding to complacency and reversing past reforms. The sun is shining. Ordinary people might think now is the time to go to the beer garden or to the swimming pool, but as others have said, it's also the time to fix the roof. What is the problem with the German roof? If I may say so, what are the main fiscal and structural reforms needed in Germany? I see, or the Commission sees three. On the one hand, we have the large public and private investment gap accumulated over many years, both in infrastructure, education, and digitization. Second, we have a shrinking skilled labor force. And third, Germany also has increasing income inequality and increased poverty risks, which challenge the status quo of the middle class, and even the lower class feels at risk of not being able to catch up with the rest of the economy, and that is, of course, inviting for populism. What does this mean in policy terms? I think, or the Commission thinks, and we also say this in our recommendations, when it comes to the investment gap, we need infrastructure investment. The investment gaps in infrastructure needs to be addressed with urgency, be it public infrastructure, notably at the municipal level, where we had negative investment over the last decade, but also what is in Germany private infrastructure, which is telecommunication, railways, and energy system, where we have new business models, new challenges, and where we have to adjust, expand, and perhaps totally change the infrastructure, such as in the case of energy. And then The second is the high-speed digital networks. I make it an extra point because here we have also the problem that we have a lot of cases where there is need for public sector involvement, be it regulation or subsidies, in the expansion of high-speed digital networks, because in rural areas, mainly in rural areas, the private rate of return is not sufficient to recover the investment cost. And this regulation could be public service obligations, or if you hesitate to go for regulations, you could also go for subsidies. The second point, shrinking skilled labor force. I think the important issue is not only that the labor force is shrinking, but also that the skilled labor force is shrinking. We heard it this morning. I think there we have two priorities which might need extra money. One is the reintegration of people who haven't been in the labor market, such as women who had looked after their children, or long-term unemployed who have fallen out of the labor market. I think here it is clear what is needed here is, for the first group, perhaps affordable and comprehensive full-time childcare boarding schools, which would help to get the women into the labor market, but also when there is a modern family model, the fathers into the labor market. And what we need is lifelong learning for those who have been out of the labor market, that they are reintegrated via training. And the second is, of course, we have a huge group of immigrants and refugees, which could be a potential source of skilled labor force, but for that there must be the political will to integrate them. And the third element is pension reforms when it comes to dealing with poverty. Despite recent reforms, there is a need to extend working lives by increasing further the statutory retirement age, because life expectancy is growing. And normally one should say 50% of the extra life years earned should also be used for active labor market activity. And one would have to look at the pension adequacy, which is also an indispensable element of the reform, whether it's in Pillar 1, Pillar 2, or Pillar 3, but that is what is needed, and that is also what should be possible. The third element, the problem in the roof or the building of the German economy, is the increasing income inequality and poverty risks. I think there one has to look again at tax reforms. Here one should in particular consider cutting income taxes or social security bond contributions at the lower end of the wage scale to create incentives for entering the labor market, but also to make the tax system perhaps a little bit more progressive. And also, Germany still has a huge untapped potential on making inheritance and wealth taxes yielding more, which could also generate revenue for additional public goods. And then I think it is also clear education and healthcare expenditure have to be reformed, the financing has to be reformed, and more money has to be put into notably education. And when I say education, I mean not only school education and university education, but I also mean education over the life cycle of a person. So, fiscal space. The good thing is that Germany has fiscal space to deal with a lot of these issues. But of course, this fiscal space did not fall like manna from heaven. It is a result of fiscal consolidation of policy, but over the years, Germany has mastered to fulfill the conditions of the European fiscal rules, of national fiscal rules, and that which peaked at 81% is now approaching 60% and is expected to be falling below 60%, even if there were some economic hiccups. And in with respect to both domestic and European rules, Germany is in the comfortable position of being an overperformer, an overachiever. This is a comfortable, but it is not necessarily a popular position, because like the overachiever in class, normally he doesn't have many friends, and when he wants to have friends, he should not simply become worse pupil, but he should help the other pupils in the class to also perform better. That is the way how the overachiever can have more friends and even benefit from this, because then the average of the class is improving and he is also learning a lot more. How big is this fiscal space? According to our estimations, Germany could relax its fiscal position by more than 1 percentage point of GDP in 2018, while still complying with the preventive arm of the Stability and Growth Pact and while still complying with national debt brake. To please Ludger, I translate more than 1% into absolute figures, which is above 35 to 45 billion euro a year, not in an election period. So even with this, rules would be obeyed, but it's of course a policy choice of Germany if it wants to go for this. The question is now, is there the risk of this could create overheating or things like this? There we think no. Germany is at present growing a little bit above potential, but first, this money could be used for improving supply conditions. Second, the labor market is still flexible, elastic labor supply. And third, this could, of course, also lead to higher, and which we are already seeing, higher investment in equipment, so the potential growth could be growing as well. By the way, this would also have a nice side effect, and then I come back to the pupil in the school, because you might want to discuss the size of the spillover effect, but there is a positive spillover effect. It is clear, nobody would contest when we talk about economic developments or fiscal developments in America and in China. This has good spillover effects or macroeconomic implications for Germany. The same holds for fiscal and economic developments in Germany. They have macroeconomic implications for the neighboring countries in Europe, and that is where we should aim at and what we should not neglect. A final point, it is true, the sun is shining. It's now the time to fix the roof, but policymakers like the general public prefer to use this nice weather than to go to the swimming pool or to the beer garden. And when it's starting raining, some might then want to move from the beer garden to the beer tent. And my appeal is, of course, that this should not be the way how, for example, the fiscal space would be used. The fiscal space should be used to increase potential output in Germany and to deal with these three issues I mentioned. Thank you.
Thank you very much, Manfred. Also for being very clear. Lars, the floor is yours.
Yeah, well, I'm happy to offer you a different view.
Disappointed.
Well, first of all, I'd like to kill the straw man still existing in public debates in Europe. There's no such thing as austerity anymore. Since 2015, at least, we have slightly expansionary fiscal policy when we look at the change in structural primary balances in Euro member countries, in particular also in Germany. What we observe is that the current expansionary policy in Germany is already, in a sense, a contribution to the situation in the Eurozone. When we look at what Germany should actually do, given its position in the cycle, something like a balanced budget, the black zero, schwarze null, is not sufficient. They should have higher surpluses even then to reduce the debt to GDP ratio. And this is not done. That's what we do not observe. So to an extent, the expansionary fiscal policy that we observe is a concession to the European partners, so to speak. I'm thinking that, that's my second remark, I'm thinking that the traditional analyses of sustainability that we conduct, in particular to look at what the social security system is doing and what we need to do in order to come up with a more sustainable fiscal policy in the future, that this does not, in my view, directly lead towards a particular recommendation given current policies that we have to conduct. The reason for it is simply they are very deterministic, these typical analyses. You can find out what the implicit debt to GDP would be and then try to find out what you need to do next. But I think this mainly aims at finding out what would be the measure in the pension system and the healthcare system and so on. But it doesn't help you in a situation where we usually have a stochastic environment where we have expectations of financial markets that finally drive the assessment whether a fiscal policy is sustainable or not. According to our analyses, we might simply have a situation where a fiscal policy that was deemed to be sustainable yesterday, given certain changes in environmental conditions today, meaning in interest rates or in growth rates or in politics, will quickly lead to a different assessment of financial markets, and this could easily lead towards an unsustainable fiscal policy in the sense that refinancing conditions are increasing steeply, deteriorate steeply, and this will finally object the goal of sustainable fiscal policy. That's what we usually observe in countries that finally have to restructure. I would not say that Germany is in such a situation. But what we see is that even larger countries can get into such troubles when we look at the Eurozone debt crisis in 2010, 11, and 12. And therefore, I'm still recommending Euro member countries to aim at a reduction of their debt to GDP ratios and aim at getting them below 60% and even have sufficiently large gap to the 60%. When you think about a situation in Ireland and Spain, when they got into trouble, they were below the 60% debt to GDP ratio, and quickly their fiscal policies were unsustainable. So each member country in the Eurozone should, in national responsibility, reduce their debt to GDP ratios and consolidate in order to come up with sounder fiscal policies. And this also holds for Germany. We are still above the 60% criterion, so there must be an additional effort to reduce the debt to GDP ratio further. Still, I believe that there are possibilities to spend some money or reduce taxes in the short run in order to increase potential output growth. Something might be done in that respect, but I would rather aim at tax reform than at additional public spending. What we see in income taxation in the German case is that we have a slow increase of the tax burden across time due to bracket creep. This amounts to 30 billion euros when you calculate from 2010 to 2016. Now we have 2018, so it is definitely a little bit higher. And these indirect tax increases across time could be given back to taxpayers. We should always keep in mind that the personal income tax in Germany to a large extent also affects firms, in particular the small and medium-sized enterprises. And also a reduction of the German solidarity surcharge would help because it also is a reduction of tax rates. When we abolished the solidarity surcharge, it's also a reduction in tax rates for corporate income taxpayers. And given the changed situation we have in tax policies across the world, in particular the US tax reform, which is a tremendous effort to get additional investment spending in the US, have domestic investment increases in the US, we must be aware that we are not alone here in Europe. So we are not an island without any further things happening around us. And I strongly believe that we have to react to this tax reform, first by reducing tax rates. Solidarity surcharge is one element. On the other hand, by looking at structural changes in the tax base. The German Council of Economic Experts has for several years made the proposal to shift towards a consumption-based corporation tax, which would finally help to reduce the distortions that we still have for investment. Regarding the need in infrastructure, I'm always still hesitant to endorse something like an investment gap. and all the calculations that we see there. We must keep in mind when we look at investment of local jurisdictions that there was a large extent of outsourcing at the local level. And what they outsourced were firms that could finally invest, and they did it. So when you look at the investment of those outsourced firms at the local level, investment did not decline to the same extent that the official statistics show you. What we also have to keep in mind is that the construction industry is already running above capacity in Germany. And everybody who is thinking about further infrastructure investment should be aware of the fact that this is mainly running into higher prices. So what we need to do is we need to prepare our economy, prepare the official decision makers at the local level, at the state level, to actually concentrate on the particular bottlenecks. What we observe instead is that states like Bavaria are quickly able to respond to the additional funds provided by the federal level because their administration is prepared to do that quickly, but they do not need the infrastructure investment to the same extent as North Rhine-Westphalia is doing. They lack the administrative capacity on the one side. We have large difficulties in the administrative process as well. We need a lot of time until we finally come up with large infrastructure projects. The money does not lack. What we need to have is a better administrative capacity and shorter periods until such infrastructure projects are realized. We are in the area of Bulgaria, Romania, and Greece when we think about the time that we need to bring up infrastructure investment. So this is what we actually need, not the additional money. Finally, allow me a short remark on long-term reforms. We can improve sustainability by looking at social security spending. You might not be surprised that the measures the possible Grand Coalition has written down in its current paper do not convince me. These are additional spending measures that will finally negatively affect the financial balance of the pension system, and they will also not help very much with respect to the situation in the healthcare system. What we need to have regarding the pension system is a link of the legal retirement age to the further life expectancy, long-term life expectancy, as we already have a situation in the Netherlands or in Sweden. This will finally help to balance the pension system. And regarding the healthcare system, the problems do not exist at the financing side, the problems exist at the spending side. We have a relatively high level of services in the healthcare system, more or less. There are inefficiencies as well to that extent, but the average quality of the services that we get in that system are relatively high, but we pay a lot of money for that. And I think that reforms in that regard might finally help when we look at the spending side of the healthcare system. So let me conclude with some remarks regarding the other Eurozone member countries. I'm still believing, as I said before, they should consolidate, reduce their debt-to-GDP ratio sufficiently in order to gain the fiscal space for future economic shocks that come up. And if they are able to consolidate in these, as you were saying, sunny times that we currently have, they will be able to cope with even severe economic shocks that come up. I was alluded to a calculation by Charlie Wiblosch when I talked to Friedrich Heinemann this morning. He was telling me, well, look at these calculations. With a 5% reduction of GDP, what you need in order to counteract that with fiscal policies is about 1 to 1.5% additional public spending. And this is something that you should manage to realize when you have a debt-to-GDP ratio below 60%. It's difficult to realize it when you have 130%, of course. So this is something that must be changed considerably. I'm not in favor of the introduction of a fiscal capacity as an insurance mechanism at the EU level. I think that what we observe in federations is much stronger insurance by capital markets and by factor movements. Jens Weidmann was mentioning the studies on the US Federation and other federal countries where you have a 10 to 25% risk sharing via the fiscal situation, via fiscal policy. We have just finished a study on Switzerland where it's only 10% in such a small country. So capital markets are compensating to a much, much larger extent there, and also factor markets are compensating to a much, much larger extent there. When you want to insure member countries against adverse economic shocks, it's better to start with capital market union and to finish banking union tend to have a fiscal capacity at EU level. Thank you very much for your attention.
Thank you, Lars. The floor is yours.
Yeah. Thanks a lot. It's a pleasure to be here. Let me start with one comment about the discussion so far. We can argue for and against the existence of an investment gap in Germany. Is it hardware? Is it software, schools, and other things? But it seems to me that even if one argues for a considerable increase in public investment, that is orthogonal to the question whether, from a cyclical point of view, the deficit in Germany should increase or not. I mean, these are, for me, two different questions. Even if one diagnoses an investment gap, I repeat, hardware, schools, others, okay, you increase the expenditure, but then a different question is, at least analytically, how you want to finance it, immediately or later. And if the cyclical position is such that at present there's no output gap, then you would say from a purely German point of view, yes, you increase more investment, but you don't run a larger deficit. Second question is, you look at the European output gap, is there a case? And then, okay, we saw that the people are really divided here. But actually, and here comes, if you want, my surprise, this is, after all, an IMF-sponsored conference. Shouldn't we think about the link between fiscal policy and the global current account position? And I think there's a missing link here between this session and the next session. And that has two elements. One is this element, if you want, the cyclical impact of fiscal policy on the current account. Jens Meitmann mentioned earlier this morning that the estimates show that the spillover effect within the Eurozone are small. But I presume they're rather large with respect to the rest of the world. At least that seems to be the assumption when the IMF pushes for higher fiscal spending or using of the fiscal space in Germany. But it's actually true in the longer run. If I look at the experience of Japan, they have had endless fiscal deficits, accumulating record debt levels, but their current account surplus has not moved much over the years. So I think, first of all, we have to ask ourselves whether for a country in flexible exchange rate regime, actually in the medium run, and that is our topic here, there's any link between the current account and the fiscal stance. I have my doubts, but that is a point which remains to be analyzed and proven either way. And then there's a second link, which also came up, but was not really pursued. We all know that in the long run, the key challenge for Germany is aging. And then you bifurcate. Aging is one argument why Germany might want to have a current account surplus. And it is one of the factors leading to future pressure on fiscal policy. But again, I think one should look at the two together. In the morning, we heard that the German current account surplus arises from millions of individual decisions. That's quite true, which result then in very large excess savings, excess in the sense of more savings than domestic investment. But then I think you have to make a comma and say that these savings are invested in a particular regulatory framework, which is that most cases German investments go into fixed income and into euro debt instrument. And that means that the rate of return available to savers is very, very low, because we have the entire euro area with extremely low interest rates. Therefore, my view would be that perhaps one should link the two. Why shouldn't the German government invest on behalf of its people, basically creating a sovereign wealth fund? The German government would then be free of the restrictions that domestic savings and the domestic financial institutions have, and it can invest in the rest of the world. After all, we know that in the rest of the world, the trend growth rate is on average much, much higher than in Germany or also in the entire Eurozone. So the rates of return you can go for there, like the Norwegian fund, would be 3 to 4% real. Right now, the rate of return on domestic fixed income investment in the euro area is negative in real terms and unlikely to change so. So even from the point of view of the German savers, it would make sense to invest that way. Then, of course, we come to the question, will the higher interest rate lead to more savings or less? And we know that in economics, we can have a backwards bending supply curve of savings. If you assume that people have a certain target income, then actually, if they know that they have a higher rate of return available for them, they might actually, in the end, save less because they know that they need less capital to achieve a certain income. And there's actually some empirical evidence for that to be happening. So I think there's a pretty strong case to be made in the long run that these excess domestic savings in Germany could be better invested by the government. And it would have the added advantage in this particular cyclical situation. The government could pro forma run, if you want, not a deficit, but it would get the money from the people and then invest it abroad, providing also a cyclical cushion over time. I was told that happened once almost, 50 years ago in the late 1960s, when there were some reserves being built up for a particular event, which then didn't materialize. Something small has happened in the reserve that has been accumulated for refugees. So if you can accumulate in the German budget lots of reserves, then the surplus doesn't appear to be high, but as a matter of fact, you're investing really for the future. Therefore, you could basically smooth out these cyclical fluctuations, which are at present saying that you shouldn't really run a large deficit for cyclical reasons, but the political pressures are high just to show that you're doing something. Coming back to the global issue, the IMF has very often pushed for sovereign wealth fund for commodity producers who have a more, of course, cyclical revenue stream. Should one not think about the same approach for mature economies which are facing a predictable aging problem? This is, I think, the real question we should ask ourselves instead of discussing whether 0.5% more or less of the deficit this year. To put it in broader terms, the question is, at present, many people say the German government should basically spend more so that its people then spend more on goods and services, which cannot be produced in Germany because it's close to capacity, so they will suck in imports, maybe little from the Eurozone, but more from the rest of the world, maybe more from China than from Italy, but okay, so be it. From a global point of view, people can argue that that makes sense. The alternative view would be that the German government takes the money of its people, instead of spending it, it uses it to buy not goods and services indirectly from the rest of the world, but assets, right? Real assets, thereby making it easier for the rest of the world also to expand its own capital base. Is that better or worse? And I think that would be, the relevant question we should ask ourselves if we take a more medium to long run view of fiscal policy for Germany. Thank you.
Thank you very much. Ludger, please.
Yeah, thank you, Rolf. It's a great pleasure to be here as well. And let me start with a few remarks on the fiscal situation we're actually in right now. Germany's general government has had a modest surplus in recent years. The federal government has had a broadly balanced budget. I mean, whether you have a small surplus of 1 or 2 billion or 5 is kind of within the margins of error when you are executing a budget. So, I mean, it confirms what others here have said. We are in a sound position, And also, when you look at the plans for the medium term, I think one can say that we plan to continue to be in a sound position. Now, I have to add here, we have an acting finance minister. We have an agreement on a pre-coalition agreement. So I have to speak here in personal capacity, but I try to be kind of consistent with what's on the table, which is, I find, not very difficult. We have this plan of spending, or kind of 45 billion of fiscal space, which is about 1.33% of GDP for the next 4 years. And this pre-coalition agreement has allocated it to a number of tasks, which I would divide into social investment and tax cuts. And the cut in kind of like, it's not quite 1/3, 1/3, 1/3. It's more like 1/2, 1/4, 1/4. But that's what is in the cards right now, and I will comment on the structural dimension of that in a minute. But I think it is key to realize that the German fiscal position is not one of enormous surpluses that we can now think about, how to use them. All the more as there are some issues that we need to keep in mind. First, the fiscal stance is already neutral to slightly expansionary. That is shown on the slide that I've put up here. I've put deliberately the cyclically adjusted primary balance because it's perhaps the best measure of the kind of the cyclical position and abstracting from the interest payments. And you can see here that also, as Lars, I think, had mentioned before, that since 2014, basically, there has not been any austerity or consolidation amongst the European countries. The improvements have been mainly due to falling interest spending. I think that is important to keep in mind, kind of from a backward-looking perspective, what we have had in the past 4 years, where some people have claimed that we have huge austerity, but we didn't. The next point here is underlying this measurement of cyclically adjusted primary balance is, of course, an assumption about the output gap and about potential growth. And Manfred mentioned that Germany now has potential growth of 2%, or roughly 2%. And that, we think is the first challenge we have. What is really our potential growth? We see this much more prudently. We see it in the short term more near 1.5, thanks to the labor market migration from EU countries. That also in the previous session was discussed. And in the medium term, of course, likely to go towards 1 and even below 1%, depending on how demographic patterns are evolving. But this is the first reason to be prudent. You have a much bigger positive output gap in the current environment if you assume 1.5% growth than if you assume 2%. And then, of course, your conclusion is already different. This shows you how sensitive the whole fiscal analysis is to assumptions. Then we have another distortion or another risk here, which is on the next slide. We have at the moment extremely low interest rates, which have pushed downward our interest payments and our plans, our prospective interest payments. And you can see here, while we've basically fulfilled our nominal budget plans in Germany, we have compensated falling interest payments, windfalls on interest payments, with higher primary expenditure, mainly higher social expenditure, but also higher investment expenditure. And that, just factually, it is incorrect that Germany has not boosted its investment spending. We have boosted investment spending significantly in recent years, and for the medium-term planning, the investment expenditure component is the fastest growing component in the government expenditure. And nevertheless, of course, we have this problem of strong dynamics of social expenditure. But I wanted to point here to the windfall from interest payments, and hopefully at some point when the ECB normalizes its rates, and we will potentially see also global rates rising, then we will see a reversal of this. The third windfall that we may have gained is on the asset price cycle. You know from the period before the financial crisis that a number of countries have had huge windfalls from the real estate market, from stock markets. In the case of Spain, these were probably several % of GDP. And then, you know, when an asset price cycle turns, it can quickly give you big and bad fiscal surprises. And we have not gotten a strong methodology on this, but our rule of thumb estimates are that this asset price cycle, you know, windfalls on house purchase tax and consumption effects, etc., may be as high as 0.25% of GDP. But this is an area where fiscal economists should spend much more time and much more energy on how to include, so to speak, the financial and the asset price cycle in their fiscal analysis. I've done some work on it in a previous life, but right now I don't have the time anymore. The next point I want to raise is, you know, when you look at where fiscal policy should go, where you look at the externalities that this creates. And I think the question is really what is good for, what fiscal position of fiscal policy in Germany is good for Europe and for the rest of the world. And there is, of course, the single-dimensional view of, you know, only looking at the macroeconomic spillovers in the Keynesian sense. But, you know, there are a lot more spillovers here. And simply the fact that Germany's public finances are anchored creates positive spillovers, to my mind, through low benchmark interest rates against which others' spreads are measured. So low German rates means lower interest payments for everybody. This is a significant positive spillover. I've asked in earlier discussions with international organizations to maybe measure this, try to measure this, but so far also here we are not really haven't really come to conclusions. The second spillover is, of course, you know, German rule compliance, and not only in the sense of the European rules, but also the national rules, because our national rules, unlike what Manfred said, don't grant us a space of 1% of GDP. We are going to be actually pretty close to not meeting our national rules in the next legislature. I mean, we are going to meet it, but there is not a big reserve. This rule compliance builds confidence. It builds confidence in Germany. It builds confidence, well, it should build confidence in Europe, because rule compliance has a value by itself, as we all know, not only from the fiscal area, but from all other areas of our daily life. So let me go to a few challenges at the more global level, because I think, Daniel, you pointed out that the global dimension is very important as well. And here maybe we can see the next slide, which shows that, of course, we have the aging issue, that's well known. And the aging issue should tell us something about how we should prioritize our budget. And this is where I'm not totally, you know, happy with what is currently being discussed in Germany, I have to admit, because with this kind of population aging, you know, you shouldn't really kind of raise the base of social expenditure before the aging hits, or when the aging just starts to hit. And we are a bit of a risk at risk of doing that, and have done that already in the past legislature. So we have a big challenge here, and but you know, good times are difficult times to do these kind of reforms. And then that links me up with the table on the right, which shows you, by international comparison, the size of European governments. And the difference in the size of European governments with America, Japan, Singapore is not public consumption. Public investment, also very little. In a country like Singapore, public investment is even higher than here. But it's the size of the welfare state. And you know, the size of the welfare state is very high. Public spending is very high. And then if you then go in and say Germany should spend more money at a time when we are in a good economic situation, where there are no obvious constraints, you know, if somebody tells you to spend more, then what is the money likely to be spent on? The political economy is not so favorable towards investment. It is very favorable towards social spending. And we should look at the global context. With a spending ratio of 45, 50, 55% of GDP, we risk to have a kind of a global competitiveness problem, because it means we have to have high taxes, and we will have, by definition, high marginal tax rates. So I have sympathy with the conclusions of previous, I think it was Lars who said that more of the margin should be spent on tax cuts. I have to say that. Finally, my last slide, also provocative, and please don't overinterpret it. We have to learn from the previous crisis. In the previous financial crisis, preceding that crisis, many countries have had very lax fiscal policies, leaving them little room in the crisis. We've even had, as I think, was it Daniel or Lars said, countries which had surpluses and strongly declining debt ratios that then got into trouble. That's partly the asset price cycle that I've mentioned because revenue collapsed, but it's partly also the expenditure dynamics that then picked up in good times and then couldn't be brought down again in bad times and then had to be, or then became cyclical because countries got into trouble and they had to bring down these very high spending dynamics. And I mean, just don't overinterpret this slide, but the parallel between the German and the Spanish budget primary balance is quite striking. And the good part of it is good, but we have to prevent that we get into the bad part of it. So we should not stimulate unduly asset price cycles. We should not get into a position where, the German public finance is becoming structurally weak. And so that way, in the last G20 presidency, we discussed this under the term resilience. That way, Germany, as an anchor also of European stability, should preserve its resilience should we ever see financial troubles again. Thanks.
Thank you very much for your intervention. I see there's actually also a quite high degree of consensus on the panel when it comes to the request of asking for more structural reforms or asking for more reforms, improving the quality of the budget, and doing so either via spending, useful spending, or via taxes. There is one point that is certainly behind what was now discussed, and that I think I would like to make explicit in asking you, and then we turn to the floor, which is the relation with the fiscal rules. And I referred before to the experience that we have had in the past with German performance under the fiscal rules, and now there was also reference to that the overperformance is best in class and may be soon be gone if the current coalition agreement or the result of that agreement may be implemented. So my question to you is, what is it actually that, in your view, drives the current fiscal position, and what can we learn? What are the lessons to be learned for the performance of fiscal rules? And that also with a view to the current discussion that is ongoing, how should we in the future think about the fiscal rules in the euro area? Is there anything that we can derive from this? That is a point where it would be very much interested to get your view. A second element, and here I would like to particularly give Manfred the floor again. There is this medium-term perspective where clearly Lars and Ludger asked to say, basically saying we need to save now in order to be prepared for the future. I think it's the Commission is, and you are very well aware of the demographic challenges, you're aware of the debt situation, you have certainly done your stochastic simulations as well, so I would like to give you also the possibility to reply how you see this medium-term perspective in this regard.
Yeah, perhaps first on the fiscal rules. It is uncontested the European fiscal rules are not lacking complexity. They might be lacking easy communication features. The old rules, minus 3% in bad times, not more than 60%, that was something people who know how to calculate percentages could understand. Now we talk about medium-term objective of minus 0.5% structural adjusted balances, and then we have tailor-made issues so that we make corrections for one-off events and one-off spending and for earthquakes and refugees and pension reforms and you name it, I say yes, that is what we are catering for. There is perhaps a little bit of overdoing on this latter part. It is all defendable what we have in the European fiscal rules because I think it even started with Germany, who said, yeah, we should have a special provision for German unification, and that we have taken over the debt of the Treuhandanstalt. And everybody said that you have a point. But of course, then others also come with other issues. And as a result of this, we have now something which is having the only advantage is commonly agreed by the 28 member states, both with respect to what should be in and how it should be calculated. By now, we have also seen, okay, one could even make it better when it comes to what is now the output gap, what is potential growth and things like this. Shouldn't we switch to expenditure benchmark or things like this? I think when you talk about fiscal rules, there's no need to, let me say, add an extra safety margin. I think that we have, so that also when you respect the European rules, you can also cater for bad times. Of course, I don't talk about times, recessions like a financial market crisis. There I hope this is a once-in-a-lifetime shock. But on others, we have the safety margin. So if you want to reform the rules, you should perhaps make them simpler again, and perhaps easier to communicate, so that the ordinary people in the street understand what it is, and that people don't say, why is Europe teasing us, although we are doing rather well on the 3%, 60%. The other element is also what we can learn from the fiscal rules. Those who have taken ownership of the fiscal rules, including Germany, they have done their homework, and they are now in a very good shape with respect to the sustainability of public finances. Those who haven't, they had now to go an extra mile in bad times to put their fiscal situation in a sustainable pattern. On the other issue of shouldn't we save now and spend later, I think first the Commission's position on current account and public spending is more nuanced. We don't say the link is that, but it is more about investing for increasing potential growth. You can, of course, say from a Keynesian point of view, we wait with the investment in infrastructure, we wait with the investment in education and in public infrastructure, in private infrastructure, until we have a recession, and then we have a deficit spending. We at the Commission think it shouldn't be like this. We have identified the need, you can discuss the size of the need, but we have the need, we have the new business models, we need new energy infrastructure, new transport infrastructure, new digital infrastructure. We have to repair our education system to a certain extent and other issues. Why do you want to wait? Only because the economy is doing fine.
But who said we should wait?
Yeah, that was what I understood. We should not spend now. We should not spend now. We should, in principle, wait until we have bad times. And that is where I say, no, spend it now. And the good thing about it, when you spend an investment, as Ludger has said, from the political economy point of view, that is not very popular. But I think when you have these good times and you see the need, you can invest in investment now, in this now. And then you have your stimulus for higher potential growth. And as a result of this, you also have then higher economic growth and labor market performance and all the good things. Sovereign wealth fund, there I would say, for a big major economy, I think there should be enough domestic investment projects. You don't have to put the money aside and invest abroad. For commodity-driven economies, like the oil exporting countries or so, or like Norway, they might say, okay, we want to invest the money abroad to prepare for aging. But in Germany, there is still enough domestic investment potential also for quasi-public goods. And that is why I would say it should be spent now, and we can discuss how much should be spent. That is the domestic policy choice.
But the Commission's, if I may just, the Commission's own forecasts say that a substantial current account surplus remains in equilibrium for Germany just because of the pure aging. So for that part, a sovereign wealth fund would be justified.
Maybe we go one by one, and please don't forget the question that I raised on the fiscal rules.
Yeah, well, I think Manfred has said a lot about fiscal rules. I think that the more sophisticated rules that we meanwhile have, when you look at the whole literature, requires more complicated things or more complication than we had in previous debates in the 70s or 80s and so on. So even if you look at, say, the Swiss debt brake, you see that there are, of course, complications in it. It is aiming at a structural balance. It is aiming, providing for particular extraordinary circumstances and so on. So I think it is possible to simplify the Stability and Growth Pact and all the fiscal rules at the EU level. When you simply look at the, how is it called, the book that is accompanying it, then you will realize the many, many pages could be reduced by 100 or 200 or 300 perhaps in simplifying the fiscal rules at the EU level, but still it will be more complicated than simply saying 3% of deficit to GDP and 60% of debt to GDP. It must be more complicated. So this is one thing. The second remark I would like to make is regarding when you were saying saving now and spending later or vice versa. Well, I have said in my short presentation that I can imagine some additional spending in some areas, and that I can also imagine that we have tax cuts and a reduction of tax revenue in that sense. But I would not forget to reserve a certain amount of the additional surpluses that we are going to realize in order to reduce the debt to GDP ratio. So this is something I would like to emphasize. I would not take the whole amount and put it into the reduction of the debt to GDP ratio, but I would be careful what I'm wishing for regarding spending increases and revenue decreases. And what I'm also arguing is shift your attention from the spending side to the revenue side and look at what we could do in order to improve our tax system. We are, as I said, not an island. The American tax reforms will change things to a large extent. The US is running again, as it did before, twin deficits. This tax reform will lead to high budget deficits. It will also lead to strong capital movements from other countries to the US. When you look at the different measures that are important in that regard, it will certainly have an additional capital import. And therefore, I think the emphasis in this debate about the balance of payments is, to my view, too heavily driven by a look at the current account instead of the capital account. The capital account is much more important in that regard, and is much larger, to much larger extent driven by the conditions for private investors in the different member countries. And I think a sovereign wealth fund will, of course, not help in that extent. When you are accepting a certain amount of current account surplus and think that this should be accompanied by a sovereign wealth fund investing somewhere outside of the Eurozone, you might justify that, but I don't see the point that the government is necessarily investing to much more in a much more sophisticated way than individuals would do. This is something you have to show us in the German case in particular. Political economy reasons play a role. So I have not seen yet that the pension funds that were accumulated in some of the German Länder and some of the German states were really smartly invested. I had realized that North Rhine-Westphalia even invested in Greek government bonds. So I'm not convinced that these sovereign wealth funds in Germany work that well as the Norwegian one does. So this is something we should keep in mind as well.
Just to say that a lot of private investors made quite some gains on Greek government bonds over recent years. Anyway, that's a different conference.
But not North Rhine-Westphalia, you know?
No,
the brief answer is that as long as you are subject to German regulatory constraints, rate of returns are abysmal, and the Norwegian wealth fund, which has no constraints, has done much better. And I don't see why even, let's say, given the political economy in Germany, we shouldn't be able to have something similar in Germany. Close parenthesis. on fiscal rules, I think the complexity in the European level we can discuss ad infinitum. Experience is that basically we couldn't enforce the 3% limits and the more details. So every time a country chooses it wants to do something else, some rule is invented to allow to do it. So I think that's the reality. The only thing which has really kept some psychological and political value has been the 3%. But let me link again this question of rules with our topic here of investment. I did not say one should postpone the investment. I think Ludger neither. It's just a question in the cyclical perspective, right? In a cyclical, whether you should run larger deficits today or tomorrow, right? On the cyclical perspective, I would say there's very little case to be made that you run larger deficits today in Germany. Let me come back to the medium which takes that out. And here, the link is again the question, what about spending on investment? Germany had this golden rule, which I never understood from an economic point of view. Because if you say investment spending can and should be financed by deficits or by debt, right? It doesn't make sense, because should be what can be maybe financed by additional debt, it's additions to the public sector capital stock. So the net investment should be related to debt accumulation. And that is, of course, very important at the European level, because if you were to apply that rule, if you looked at the net public sector investment, you would find that in many countries, including Italy, for example, it is negative. So if you had applied a modified 3% rule adding net public investment, actually the figures would look worse for some countries, not for all of them. And again, for Germany also, I would say if we make that case, and I have my doubts, but if it can be made, then very strongly I would argue that the only economic case is it can be made in a medium-term perspective is to link perhaps some additional debt accumulation to net additions to the public sector capital stock. And of that, we have seen very little in Germany, I think, over the last years.
Yeah, thanks. I'd like to make 3 points. The first one is I think that we have been pretty good Keynesians. I mean, we have a balanced budget in good times. We have run a pretty much neutral fiscal stance in good times. And so, I mean, from that perspective, incidentally, you know, I've been in finance ministry for 6 years. Politicians love the Keynesian approach because it invites them to act. So we have, I think, acted pretty much in line with the true gospel. The second point is, what do the rules actually do? If I look back at my experience, I must say that, you know, I've sometimes asked people who are so much for fiscal expansion to come to us and do an internship or something. But you know, what fiscal rules do, like this, you know, schwarze Null translation of our debt brake, which is in a way also, you know, the kind of in line with the Keynesian approach. It forces you to prioritize. And I think that is the key. It forces you to prioritize and to make transparent where you put your priorities. If the 45 billion people can see, well, people try to obfuscate, of course, but they can see that a lot of this is on social. You know, the SPD can be quite happy about this. And the tax part is very limited. And then what does this mean? What does this mean? We're talking about inclusive growth and social peace and all these things. I think it helps social peace because, you know, if you have demands of 100 or 200 billion and you can spend 45, you know, everybody knows this cannot all be satisfied. And it also constrains you already ex ante not to make some crazy demands. So I think it's actually for the German political process with this complicated majority situation, it's actually good that we have it because it also constrains our discussions and it contributes to peace. The third point is relating more to the specifics of European rules and linking the German rules with the European rules. I think we've tried in a way to be deliberately consistent with the European rules. But I agree with everybody on the over complexity. The perfect is often the enemy of the good, and then over time you add these provisions, often not for economic but for political economy reasons, and then you end up where we are now. So this is a tricky challenge. But the more tricky one is, I think that what we've done also the past 15 years is we've distracted from the real issue by focusing on another battle. We have focused on making the rules more complicated and more pseudo-economically sound. But the real issue is, of course, the governance. We do not have an incentive structure in place that is conducive to an implementation, a strict implementation. It's conducive to a very flexible implementation. And the third issue that is a problem here is we've, some years ago, Germany, I think, induced countries to sign up to the Fiscal Compact and translate the SGP rules into national law. And we've seen great deficiencies there too. So in a way, we don't really, if one is honest, have a consensus in Europe on the need for fiscal discipline. At least so far, we didn't have it. And perhaps the current environment where debt is free is also giving us a bit of an illusion there. But to my mind, for the long run, the compliance with fiscal rules in Europe for the stability of Europe is absolutely essential. I think that basic lesson we must not forget. So if we talk about the future of fiscal rules, we have to keep that in the back of our mind.
Thank you very much. At the start, I asked you for your opinion in order to have this engaged discussion. At least I was successful on the engaged discussion. I still want to give the floor to you for questions. Given the time constraint, I would allow for 2 questions, and please be short. And also, as in the previous round, please tell your name and your affiliation. So 2 questions could be Friedrich. And
Friedrich Heinemann, Center for European Economic Research. I would have a question to Manfred Bergmann. You gave a very determined recommendation for more distributive measures, more tax progression, wealth taxes, inheritance taxes. You base this on this observation that the inequality is increasing in Germany. I mean, this is heavily contested. We have the experts will be in the room today. So, but even if I leave aside this quantitative question, I mean, you're moving into a value judgment, which according to EU constitution is normally left to the voters in the member states, because we know that distributive judgments are very different across voters in member states. So my question is, why do you move so strongly into this ideological territory? Is it, what is behind it? Is it that you see a very strong link between equality and growth? I mean, this is also heavily contested. So I would love to hear more of your prior belief on the link between equality and growth, and why do you risk really to go so strong into this debate?
So the next question is for Professor Schmidt. Please, in front here, microphone.
Thank you very much. I'd like also to pick up on the powerful image that you generated in the beginning. You picked up on it, the overachiever. And of course, it's not meant literally. To picture Germany as an overachiever is in some sense also incorrect for many reasons that were partially mentioned here. But I think it's important because images are very powerful to not draw the wrong conclusion from that image. So I see this pimpled, ugly kid in front of me who is the only one having a car, and he's allowed to drive the cool kids to the party, but he's not allowed into the party. So he's turning to you and saying, well, what should I do to be allowed into the party? And in a sense, your suggestion is you should do their homework for them. And if you turn to me and would ask me what should I do to earn their respect and become friends with them, I would say, well, you should spend time with them, you should help them, but you should also adamantly say what you're not doing for them. Earning their respect will not be doing their homework, but helping them to do their homework better and to reach a more fulfilling ability to solve problems later on their own. So I think that returns to the question of the adamant insistence of the adherence to rules. It makes sense in a long-term view, also for those who are felt to be taught by some overachiever kid?
Sounded more like a statement rather than a question. In any case, I would like to give each panelist a very short 1-2 minute statement at the end, if you want still to react to anything, and certainly you will answer to the question posed.
Okay, thanks. It's nice to see that my intervention provoked a little bit of a question, so it already fulfilled what it was supposed to achieve, at least a little bit. On the other, there is no contradiction in positions. I didn't say that the good pupil in the class should do the homework for the others, but he should help them in doing the homework, perhaps train them a little bit, help them to, as we say in development assistance, help them to fish and not give them the fish, learning them to give the fish. And that is, I think, what we need here. And then we talk also, of course, of spillovers, and that is in the European discussion we are having here. One could also help via having now higher potential growth in Germany. On this wealth and inequality, I think you said value judgments. I think economics is about value judgments. I think nothing is really totally neutral. It's not, let me say, physical science where you have natural laws. It's always about value judgment. One can also say, is the recovery coming fast enough? Is it a recovery or is it an expansion? These are always value judgments because you have a certain benchmark in mind, which might not be met. And in the case of inequality, it is clear. When you look at international comparisons in Germany, Germany is, when it comes to wealth inequality, one of the countries with highest wealth inequality in Europe. When it comes to market income inequality, also Germany is there amongst the ones which have the highest market income inequalities, which is then corrected via social policy, via transfers, and it's good so because this is also a public good. To redistribution is a public good, which is normally not generated by the market, so the government has to come in. And then one has to see, we talk about also inequality of opportunities, and that is when it comes to wealth, and then the natural invitation to discuss the inheritance tax, for example. But that was not the key of my speech.
Yes. Well, discussing about redistribution will lead us to another hour, I guess. I'm strongly contesting this view because I think that we have forces increasing the income inequality in Germany since 1984, in West Germany since the beginning of the unified Germany until 2005, and these forces continued after 2005. And the fact that we have a stagnation of the income inequality since 2005 is a kind of a success story because we managed to reduce our unemployment, and this is compensating for the other factors that usually increase the income inequality. We should sell that as a success story instead of helping the Commission to finally come up with proposals for tax reform that ask member countries to conduct further redistribution. I think this is not the task and the responsibility of the Commission. The member countries are in charge of tax policy, and they should finally come up with their own redistributive judgments in their own policies. Only a small remark. Finally, I wanted to intervene on this investment thinking. We should keep in mind when we look at education and we want to improve education that the results from several studies that we know show that the quality of our education is mainly depending on the quality of teachers. This is consumption spending. I think to a lesser extent it depends on the quality of the school toilet.
So please be short. Daniel, Ludger,
I don't want to get too close to those points, but I think the key is the questions about whether you want to spend more on infrastructure, investment, and others is orthogonal to the question of whether you want to have a cyclically fiscal policy, meaning whether a higher deficit is appropriate right now. I think we all agree that it's not in the interest of Germany. Then we switch to the Eurozone, and there the output gap is subject to discussion, let me put it this way, but it's also closing at the global level. I mean, if it doesn't spill over into the euro area, a lot must spill over into the rest of the world. What's the output gap doing there? Also, as far as I know, it's closing. And that comes to the old adage that fiscal policy has also long legs. What good is it for the rest of the euro area and the rest of the world if the German coalition now decides on a big fiscal boost in Germany, which will materialize 1 or 2 years down the road when the global and European output gaps presumably have closed? We're going again in this age-old problem that fiscal policy then becomes pro-cyclical in reality. So I would be very careful in making that case. You have to take the lags into account and the global output gap, where is it right now? And that case needs to be made. And then, I repeat, if we agree, and that seems to be a broad agreement, that aging remains the challenge for Germany, both on the fiscal side and as a cause of the external surplus, then I think I would put the two together. And if you want, my fiscal rule would be that the government should take a couple of percentage points each year and invest it on behalf of the German people, a la Norwegian Sovereign Wealth Fund, in the rest of the world. Again, perhaps up to the IMF to say, okay, what would be the global implications? Germany is not the only country to age, right? But still, I think, given the relatively strong aging in Germany, a case can be made that the German government should take care of the future of its own pensions this way.
Yeah, I think that the discussion on the fiscal stance is a bit of a distraction. I think our fiscal stance is appropriate and our position as well. I don't need to repeat that too much. But the medium to long-term challenges, of course, for Germany are quite formidable. I think we need more of a discussion on the size of government and how to deal with aging. And I think we also need to look more closely at the fiscal and quasi-fiscal risks that come from the financial sector, from future financial stability risks and so on. And as regards the kind of the interaction with our European partners, all these images are a bit wonky, but I think that we are on a good course there to have a debate amongst partners to improve the rules and to improve the environment. But the current proposals that are in the air are, to my mind, emphasizing this dimension of the future stability of Europe too little.
Thank you all very much. I think we owe the panelists a big applause for what was not only very engaged but also interesting, insightful discussion.